Hello friends, in today's video, let's look at a nuclear plant and how its decommissioning cost can be accounted for as per IAS 16. Hi, my name is Pratheej and welcome to Deep Dive into IFRS. So as we already know, decommissioning costs are the costs required to dismantle an asset and restore the site on which the asset was used at the end of its useful life. So suppose you build a nuclear plant. The purchase cost and directly attributable costs come to $1 million and the useful life of this nuclear plant is 20 years. So as per the agreement, at the end of its useful life, that is on the 20th year, the plant has to be dismantled and the site has to be restored, cleaned up and given back to the government. And suppose at the end of its useful life, that is in the 20th year, the dismantling and decommissioning costs come to $100,000. This is called decommissioning cost in this example. So this has to be capitalized along with the cost of the asset, as we already know. But this 1 lakh USD should not be directly added to $1 million. That is the wrong method of accounting. What has to be done is we should arrive at the present value of this $1 lakh and then add that to the $1 million of the purchase cost and directly attributable cost and then show that as the asset value. So what is present value? See, a few years back, we had to spend around 50 rupees for getting 1 liter of petrol. Right now in 2025, for the same 1 liter of petrol, we have to spend around 100 rupees. And suppose by 2035, it costs 150 rupees for a liter of petrol. So if you see in all these 3 points in time, the constant factor has been 1 liter of petrol, but the value of money has changed. So 50 rupees a few years back is 100 rupees now. But for the 100 rupees and 50 rupees, we are getting the same 1 liter of petrol. And the value of 150 rupees in 2035, if we bring that to its present value, equating that to the quantity of petrol that we are getting, then that 150 rupees in 2035 is equivalent to 100 rupees in 2025. So this is what present value means. If we calculate, we use something called discounting factor to arrive at this present value. So if we assume a discounting factor of 5 rupees and use that for the calculation of the present value of $1 lakh, the value comes around 37,700 or something. For ease of calculation, we can take that as 38,000. So this 38,000 has to be added to the $1 million of purchase cost and directly attributable cost, making the total value of this nuclear reactor to be 1,038,000. So let's check the accounting treatment for this. When we are building this, the purchase cost and directly attributable cost comes to $1 million, and this is actually paid. And the third part is the decommissioning cost, which is the present value of which is $38,000. So the entry for this would be nuclear plant account debit 1,038,000 to bank 1 million to provision for decommissioning obligation 38,000. So after this, as the total value is 1,038,000, we provide depreciation on this total value only. And at the end of the first year, we do something called unwinding of interest. So what is this unwinding of interest? See, every year we have to add the interest element to the provision for decommissioning obligation. What this will do is the provision for decommissioning obligation will come to the total of $1 lakh at the end of 20 years. So as per this calculation using 5% discounting factor, the unwinding of interest amount for year 1 comes to around $1,884. So if you see in the table that is displayed here, this is showing the year wise unwinding of interest figures. So as you can see, for the 20 years, if you added all these unwinding of interest figures annually, the total of provision for decommissioning obligation at the end of 20th year would be $1 lakh. So the entry for this would be interest account debit to provision for decommissioning obligation 1,884. That is for the first year, and for the second year, third year, the respective figures as per the table shown would be taken. And in the 20th year, they should be paid actually for carrying out the cleaning and restoration work. So in the 20th year, the entry would be provision for decommissioning obligation account debit to bank $1 lakh. Now this decommissioning cost should arise as a consequence of acquiring the asset, like in the example of the nuclear plant, or as a consequence of using the asset. Now what does this mean? While you are acquiring the asset, there was no law or there was no contractual obligation on your part to pay some decommissioning cost at the end of the useful life. But after 2 or 3 years, just example that the government brings in a new law, and because of that, some decommissioning obligation and costs arise. This is called decommissioning cost as a consequence of using the asset. But this cost should also be capitalized and the depreciation should be calculated afterwards on the revised carrying amount. Now there is one exception to this rule. Say while acquiring the asset, there is no decommissioning obligation. But after a few years, you use this asset to produce inventory, and because of this, a decommissioning obligation arises. Now these costs should not be capitalized. As this has to do with inventory, this should be accounted as per the provisions laid down in IAS 2 for inventories. I hope this short video was useful to you guys. Till I see you in my next episode, thank you for your valuable time.